Hello everyone, it's Gene Ahrensberg again for Got Gold Report. Gold closed this week at $1,642, down 1.2%. Silver was down 2.9% to $30.34. The mining share indexes were weaker, led by the Amex Gold Bugs Index, the Huey, down 6.1%. Moving to the subscriber pages, let's take a look at the Huey. As members know, we're on the lookout for capitulation with the Huey, and that begs the question, what does capitulation look like? One way we can look at it is the relationship between the Huey and the price of gold itself. This chart goes back 16 years, and the ovals that you see are the areas that I would say we saw capitulation in the big miners. The first one is in 2000, the great exodus of capital out of mining stocks at the end of what was a 20-year bear market for gold and silver, and it followed the Bre-X scandal. Remember, Bre-X fraudulently boosted a penny stock to over $200 a share, and then it blew up when the fraud became known. And that giant V-shaped pattern that you see there in 2000 is the mother of all capitulations for gold stocks. By the end of 2000, owners of gold stocks were ridiculed. Nobody wanted them. The price of gold was somewhere around $270. As a percentage of gold, the Huey was at 14% of $270 gold. That was a capitulation. Moving just a little bit to the right, there was a smaller exodus out of the miners in 2005, and I call that the first of the unexplainable, overly harsh reactions for mining shares that soon corrected itself. In 2008, everybody remembers the global collapse of the fears of the global collapse of the banking system and the massive deleveraging that was going on then. TARP, bailouts, Bear Stearns, Lehman's, the Great Recession, that led to legitimate fears that there would be a global banking collapse, and so all equities, not just gold miners, were being sold off. That led to the second largest capitulation on this chart, at least so far. And so now we move to today, and I think we are in the midst of a capitulation that's going on now for the miners. There's been an exodus of capital from the mining shares. It's gone to chase the big markets. People don't believe that the price of gold is going to maintain the $1,600. Whatever the reasons, money has been migrating away from the gold stocks, and you see this vicious downtrend to where now the Huey has gotten all the way down to 25% of the price of gold. That's actually lower than where it got to in 2008. So right now in May of 2012, your gold, your accumulated metal, now has more buying power to buy gold stocks than it did in 2008 or in 2005. And that's just another way of saying that gold stocks have become cheap again. And once again, we have mining shares discounting lower gold prices. But how low? Well, we've jumped to the gold chart since 2006, and we've included the Huey in purple as kind of an indicator. Notice that the Huey has sold off now, sort of without gold. It's sold off down to close to the 400 level, and if we draw a line back over to where we first intersected, the area where the Huey is now, we find that that was when gold was about $750 an ounce in 2007. So in May of 2012, your $1,640 accumulated gold buys a lot more gold stocks like it did in 2007 with $750 gold. I've been saying to look for capitulation, And capitulation can look pretty scary sometimes, like it did in 2008. Bull markets are like that. I like to think of it as like riding a Brahma bull. It's not easy. It's harder than it looks, and it looks hard. And that Brahma bull tries everything it can to buck you off. Now, some of the indicators that we look at tell me that we could be getting very close to capitulation and a reversal. We have industry veterans out there like Mr. Pierre Lassonde, chairman of Franco-Nevada, saying it's time to do deals, and that's because the miners have accumulated so much cash. Here's a similar chart. I recently put up a blog post that had the theme, "The mining share gods must be crazy." Now in this chart we've added the CDNX, the Canadian Venture Exchange Index, in pink, and you can see that massive divergence that started to widen out in 2011 and has continued between the CDNX and the price of gold. Now remember, we were just talking about how the Huey was pricing in $750 gold. Well, that's nothing. The CDNX is pricing in $400 gold or less. Now we base that on the idea that the CDNX first crossed 1365, which was that October 2011 nadir. In 2003, gold was still under $400 then. Now the Huey finally answering the CDNX, that's ominous. What that is trying to signal is that a harsh reaction is coming for gold. But you know, central banks are buying gold measured in hundreds of tons per year. I don't see any end to the zero interest rates and the negative real rates and massive fiscal easing by the monetary authorities and policymakers. As Mark Faber says, they're going to print and print and print until they get some growth or go bust. For those who haven't seen it, I hope you'll look up that article, "The Mining Share Gods Must Be Crazy." I consider it very worthwhile. Let's move on. This is a simpler chart. It's just the Canadian Venture Exchange Index, and the only point we want to emphasize here again is that the CDNX has traded all the way back down to as though it is discounting less than $400 gold. That certainly isn't rational, but it doesn't mean it isn't real. It is. And the bargains out there are many. This is the CDNX over a longer period of time. And you can see that this current correction has come back down to test the same place it found support in 2010. We are therefore at critical support for the CDNX. All this may be sounding dire, but there are some hopeful signs for vultures. This is the CDNX relative to the Huey. When the trading for this chart is going higher, the CDNX is outperforming the Huey and vice versa. Now they might be going up or they might be going down, but what we're looking at here is the relative performance. Notice how the companies we call the little guys, the smaller, less liquid and more speculative junior miners and explorers in the CDNX, have been outperforming their larger cousins in the Huey since about December. Generally speaking, we don't expect this ratio to rise if we've got big trouble ahead. Here we zoom in to just the last few months, and we can see that the CDNX actually did have a tougher time in April, but it seems to have resumed its outperformance of the Huey here in May. Back to the subscriber charts, let's take a quick look at the gold chart. Gold continues to go sideways, and as the trading continues to contract into that triangle, we've got stops moving in towards the trading from both sides, from the bull side and the bear side. So once it breaks definitively out of this consolidation, you can expect gold to move and move a lot. We already have physical gold, so we're holding out for something in the green. I'm not so sure I would be confident enough to hold out for the green if I owned no gold at all. I would probably put on at least some sort of a position now or soon. Let's take a quick look at silver. Silver's in kind of a tight declining channel that's crossing through a 50 to 61.8% Fibonacci retrace box. It's actually moved slightly below it, which is somewhat bearish. Sentiment for gold and silver is just morose and defeatist. It's kind of nasty out there. And yet gold and silver really haven't cratered. Now we've decided to hold on for something down in the green if we can get it, to start another new trade, for another new short-term trade for silver. Up until this past week I had very serious doubts that we would actually get something down in the green, but now I think silver's vulnerable enough that it could be knocked down there. And like gold and silver, you've got trading stops migrating into the trading from both sides, from the bull side and the bear side. And the point is that if silver trades out of that, convincingly out of that channel, then you could expect a violent move for silver in the direction of the breakout. And so you've got the Huey looking awfully bearish, probably close to capitulation, maybe moving down to the area where you see the green down here, where support has formed in the past. You've got lousy sentiment. You've got some of the best industry minds out there saying that these are some of the cheapest prices for gold shares in history. The mining shares are trying to tell us, or at least they are signaling, that there's going to be a very large move down in gold just ahead. But some things just don't add up sometimes. For example, if the price of gold is about to fall off a cliff, why aren't the large hedgers getting into position for it? Why aren't they increasing their commercial net short positions for gold futures? They're not. The large hedgers are down close to 3-year lows for their net short positioning for gold futures. How about silver? Now, over this past week, the commercial hedgers increased their net short positioning, but only by 1,390 contracts. The hedgers are still under 24,000 contracts net short, which is a very low level, historically speaking, for the net short positioning for silver futures. Why aren't the commercials increasing their net short positioning if silver is about to see a big reaction? Sometimes markets are just downright irrational. And that brings us back to the GDXJ, the Market Vectors Gold Miners Index, or rather the ETF. As those of you who follow the charts know, we re-entered the GDXJ on Thursday at $22. So that makes us a few pennies underwater as of the close on Friday. We're looking for capitulation soon. We may not get it. And we're running a razor thin stop on this trade. Our actual stop point is 2% under the $22 price, and we'll use the usual 1-hour grace period if the trading moves below our stop for an hour and shows no sign of returning above it. Then we'll exit to the sidelines and try again another day. This is just the GDXJ again at a little bit longer time frame, and that way you can see how we get to the idea that there might be some support. Well, we're just about out of time, so if we had to sum it all up in just one sentence, the mining shares are painting a pretty grim picture. They're saying that gold and silver are going to fall off a cliff pretty soon. And sometimes they're right, but sometimes they're just not. In fact, most of the indicators that we look at they just don't agree with what the mining shares are saying. I guess they could be right, but they might not be right this time. Thanks so much for joining us. We hope you'll be here next time. That's it for Got Gold Report on May 6th, 2012. Bye for now.